Here is a testimonial for the highest paid part-time job in the world from Katrina Alexander.
So I'm approaching 3 years in this academy. All of my accounts have increased trading, investments, business, and personal accounts. This academy can produce results in all areas of your life when you do the work. Yes, you have to work on your psychology and mindset to get the results.
When you think of a hedge fund, what do you think about? Do you think about something from the TV show Billions? Or do you see scenes from the movie Wall Street? What we're going to do in this video is we're going to talk about what hedge funds are, what they really do, and who they actually benefit. Let's get into it. Hedge funds are a topic that's been talked about a lot over the past year, but they've been talked about for a very, very long time in media, in movies, in print. And a lot of people are very either hot or cold about hedge funds. Most people, they may see them favorably or they may feel like they're the worst things in the world. And what we're going to do is we're going to kind of explore in depth what a hedge fund really is, what it really does, and who it really benefits. Let's go ahead and get into it. Now, why would you invest in a hedge fund? And the mainstream idea of a hedge fund is that I'm just trying to make as much money as possible. And that's why I would put my money in a hedge fund. They believe that it's a place for the super wealthy to get even wealthier. However, that may be a misconception once you really start to understand the reason for a hedge fund, why they actually exist and what they really do. The job of a hedge fund is to hedge. And when you understand what a hedge actually does, it's really designed to keep things out or to create some form of protection. And the real job of a hedge fund is really to protect your wealth more than grow your wealth. And we're going to kind of explain why that's the case. You have a billionaire and they have a family business. They've built this business up over time. They've taken risks. They've been successful. They've done the things that a lot of people do not want to do to become successful in this economy. And they have a very, very successful family business as a result. And then what they often do is they take the profit from that family business and they will sink that into what we call an S&P index fund. And the reason why they do that is because they want to be diversified. So they don't want to just be dependent upon the revenue or the profit being created by the family business. They also want some exposure to an overall S&P index fund. And that keeps them very diversified. However, they're still exposed to the downside of both the business and the market. And what we mean by that is that if the business goes under and the market goes under, it can impact their wealth negatively. And you have situations in this economy where the business and the overall economy can both go down for a lot of different reasons that we're not going to talk about in this video. And what this billionaire will often look to do is put some of their wealth into a hedge fund. And it's for the specific reason that we talked about earlier. They want to protect their wealth more than grow their wealth. Therefore, when you're looking at a hedge fund, you're normally going to be looking at it because you want to protect your wealth more than you want to grow your wealth. Now, here's some of the structure of a hedge fund, how it's composed. Hedge funds are normally going to be limited partnership. And the reason for that partnership is that it provides tax purposes and the regulations are not as strict because of a high barrier to invest. The majority of people that would be allowed to invest in a hedge fund are going to be at a certain income level or a certain net worth level. And if you're outside of those particular levels and you can't meet those thresholds, you're normally not going to be allowed to invest inside a hedge fund. Now, in that limited partnership, you're going to have limited partners. And these limited partners have limited liability and they take their profits based on investment. And normally those are going to be the investors in the particular fund or what we call limited partnership. Then also what you're going to have is general partners. And those general partners have unlimited liability and are responsible for managing the fund. And that's normally what we're going to call the investment managers. So inside a hedge fund, which is structured as a limited partnership, you're going to have limited partners and general partners. Now, the fees for the hedge fund is normally going to be management fees based on the assets under management. Therefore, often the larger the assets under management are, the larger or the higher the management fees will be. Then you also get something that we call performance-based compensation, where based on how well the fund performs, the management also gets a compensation based on a performance metric. Now, an example of that is what we're going to call watermarking. And an example of watermarking is that If the fund is projected to hit a certain performance metric and the management hits that metric, he now has to set a higher watermark in the future to get paid based on performance. What the manager is not going to be allowed to do is hit a particular metric, have the fund go under that metric, and then just by getting back to what the original threshold was, they now get paid the performance fee again. They now have to figure out how to perform at a higher level than what we would call their last watermark. So looking at the example, you have the initial high watermark at 37.5. Then it gets updated and you have the updated high watermark at around 50, right? So they hit 37.5 and then now they have to go to 50 to continue to get that performance base. Now here's some of the benefits and risk of being in a fund. It's the potential of superior performance in a down market, and you also get diversification. Some of the risks are potential of correlated risk in a down market. And what we mean by that is that the market can go under, and also the fund can also go under. It can be difficult to perform due diligence because a lot of the information in a fund does not have to be disclosed to the public. This is what the average person does not understand. These funds are private. They're not for rookies. They're not for amateurs. Therefore, a lot of the information around this fund may not be publicly available. Therefore, you want to really start to understand why you would even want to be involved in this type of vehicle based on your objectives. Now let's go into some hedge fund strategies, because there is no one way in which funds try to generate returns. There's multiple ways that funds generate returns. And if you're looking at investing in a fund, you want to really understand the strategies that they're going to employ to generate the returns that are going to be acceptable to you. So let's get into it. So we talk about equity hedge funds. They're normally going to be market neutral. They're going to be long the undervalued securities, and they're going to be short the overvalued securities. And their job is to keep a net neutral market position. They don't want to be overexposed in any area, right? They want to be net neutral overall in the market. Then we also have fundamental growth, and they're going to be long companies with a high growth potential. And they're also going to be long undervalued securities, right? Then we also have quantitative directional. And what they do is they use technical analysis to buy or sell. We have equity hedge funds that are based on a short bias, which means they're looking to short sell stocks. And then we also have equity hedge funds that are sector specific. So they may go after energy, they may go after EV companies, they may go after the genome companies in the medical space. They're going to be based around a specific sector. Now we have event-driven hedge fund strategies. And what they often employ is something that we call merger arbitrage. And those are going to be buying the shares of the company being acquired and selling the shares of the company doing the purchase. And often what you see in the market, where if company A is acquiring company B, based on how the market perceives it, the shares of company A will get sold off and the shares of company B will often increase in value. But it's also based on how the market perceives that merger or that acquisition. Then we also have distress or restructuring companies, investing in firms that have filed for bankruptcy or about to file for bankruptcy. And then what we do is we go long to play successful restructuring, and then we go short to play the unsuccessful restructuring. We also have activist investing. And in that particular case, you buy enough shares in a company to be able to influence management. And there are some hedge funds where their claim to fame is that they're really, really big on activist investing. And that's how they generate the returns that are going to be acceptable to their investors. Then we have special situations. That's going to be investing in an event that does not fall in line with a merger, restructure, an acquisition, or bankruptcy. So there will be events that are not a merger, a restructure, an acquisition, or a bankruptcy. Now we got relative value. That's taking long and short positions in related securities. Fixed income convertible arbitrage, long on company convertible bonds, going to be short on company common stocks. Then you're also going to have ABS or MBS income. That's asset-backed securities or mortgage-backed securities, and then also general fixed income. Macro hedge funds, what they do is they identify macroeconomic themes and they take long or short positions across equities, derivatives, fixed income, currencies, and commodities. And these are going to be the specific hedge fund strategies that most funds are going to employ to get an acceptable rate of return. So when you're looking at a fund, you always want to understand what strategy are they going to take so they can get an acceptable rate of return, so I can understand how they're going to protect my capital or protect my wealth. If you're looking to invest in a hedge fund, here's some of the due diligence elements that you may want to consider. Investment strategy. Historical returns. The longevity of the fund. Assets under management. Valuation methods. Return calculation methods. Management style. Key person risk. Management systems. Competitive advantage. Reputation. And growth plans of the fund. That's going to wrap up this video. Thanks for watching. Like, share, and support. Talk to you later.